What if I told you that the number in your bank account is only part of the story? Because money isn't just money, it's a system of trust, power, incentives, and quiet decisions made far away from your daily life. And when that system shifts, you feel it everywhere, at the grocery store, in your rent, your savings, your paycheck, even your future plans. Most of us think of money as simple: you earn it, save it, spend it. But the reality is that money has rules, and those rules are constantly changing. Two of the biggest forces behind those changes are inflation and central banks. If you understand how they work, you start to see why your money sometimes seems to disappear in value, even when the number stays the same. Inflation is the rise in prices over time. But here's the important part: inflation is not just things getting more expensive. It also means each dollar buys a little less than it used to. So if your salary goes up by 3%, but inflation is 5%, you're actually falling behind. That's why inflation matters so much. It quietly changes the real value of your money. Central banks, like the Federal Reserve, don't print your cash every day, but they influence how much money moves through the economy. They do this mainly by setting interest rates and controlling liquidity. When rates are low, borrowing becomes cheaper. That can encourage businesses to invest, people to buy homes, and consumers to spend. When rates rise, borrowing gets more expensive, spending slows down, and inflation can cool off. So why does this matter to you? Because central bank decisions affect mortgages, credit cards, savings accounts, car loans, and even job growth. A small interest rate change can shift the cost of a house by hundreds of dollars a month. That's not abstract policy, that's real money in your pocket. And this is where it gets bigger than economics. Whoever understands the money system first usually gets the advantage. People with assets like property, stocks, or businesses often benefit differently from inflation than people who just hold cash. Why? Because assets can rise with inflation while cash loses purchasing power. That means money doesn't hit everyone equally. It can reward some groups and squeeze others. Let's make this real. Imagine you saved $10,000 in a checking account for 5 years with almost no interest. If prices rise significantly during that time, that $10,000 may still look the same on paper, but it buys less food, less gas, less rent. Now imagine someone else used that same money to buy an asset that increased in value. They didn't just keep money, they preserved and possibly grew its power. Or think about debt. If you have a fixed-rate mortgage, inflation can actually help you over time because your loan payments stay the same while wages and prices may rise. But if you have variable debt like credit cards, rising interest rates can hit hard. That's why understanding the system is useful. It helps you decide when to save, when to borrow, and where to put your money. So what's practical here? First, don't keep all your money sitting idle if inflation is eating away at it. Second, pay attention to interest rates before taking on debt. Third, think in terms of purchasing power, not just account balance. And fourth, build some exposure to assets over time, if possible, because assets can help you stay ahead of inflation. Money isn't just a tool for buying things, it's a system that shapes opportunity, stability, and power. And once you understand inflation and central banks, you stop seeing financial news as random noise. You start seeing the hidden logic behind your everyday life. That's the real value of understanding money, not just to make it, but to understand the world it lives in. Why money isn't just money, how inflation, central banks, and power shape your life is just one small part of money, inflation, and central banks. If you're interested, our full free Money, Inflation, and Central Banks course is linked in the description.